It is Sunday the 29th of December. I'm Jason Sen. This is a video for the last few days of the year, and we should cover the first couple of days of the new year 2020. Okay, so this is the dollar index. Now, I'm actually going to show you the weekly chart to start with. So we are in a bull trend, or we certainly were in a bull trend last year, 2018, and in 2019 we certainly have been in more of a sideways trend, as you can see if I blow this chart up and move it down to the middle. I don't think there's any doubt that this is much more of a sideways trend, and for me more difficult to trade for obvious reasons. You can't hold a position for as long as you can when you're in more of a directional trend. So we rallied up through the summer to the beginning of October into the autumn, and we declined and given up a lot of the gains, most of the gains really. So what's key now will be the trend line going back to the second week of January. In fact, as you can see, we're testing that trend line and we've rejected it quite nicely. So bulls have been prepared to buy into the US dollar down around that trend line, which on the dollar index is around 96.70, 96.60, the low there 96.54 the last time we tested it last week. And we've also got a little bit of support slightly higher up actually, around 97.00, 96.80 from the fibs. So although we've overrun those fibs, we've certainly managed to close around them above the 61.8% fib. Okay, so what am I saying here? I'm saying here that at the moment this looks pretty bullish, but I would be shorting on a break below 96.50. I think that's a reasonable read of the charts. We go to the daily chart. Well, same story, just a bit of a close-up. So the 23.6% fib is at 96.97, and as you see, we sort of closed around there on Friday, but we have held the trend line, which goes back to the beginning of January quite clearly. So yeah, those are the key levels. We've got a much more minor trend line down at 96.40. So I would suggest you would want to stop just a fraction below 96.40 if you are prepared to try along in the US dollar. Clearly we would need to get up through 97.60, 97.70, 97.80 would be the first area we'd need to get through. And then we've got some less important resistance. Can I call it less important resistance? Well, it's only a 3-month trend line at around 98.00, and then the 100-day moving average at 98.10. So we get up through 98.10, and that's going to look like a buy signal to me. Right, Aussie benefiting from some dollar weakness. We've broken above a trend line which goes back a year to December 2018. A nice break, but a bit confusing here, I have to say. That last week was the week before last was a bugger, because of course we looked like we'd broken higher, and then we spiked down and closed the week above it. Then we get the big blue candle following that fairly positive signal, and we rocketed last week. So we've got resistance, fib resistance from around 70.00 up to 70.15. That will be the key test. Now, there's nothing else there. Well, actually, no, I lie. Let's have a look at the daily chart. There is something else there to back up that level. So around, well, just below 70.00 actually, we've got this trend line going back to the beginning of October. So let's call it 3 months old, significant enough. So we do have a little bit of an overlapping trend line and Fibonacci resistance around a 70.00 level. So we're going to have to get up through 70.30 for the next buy signal. Would I be selling it here? Well, we are overbought. We are in a longer term negative trend. When you look at the weekly chart, we are in a longer term negative trend, and maybe this is just some sideways consolidation action before the next leg lower. I guess you would want to bet on that, really. I am one for trading in the direction of the trend, of course, but if we do get up through, say, 70.30, then this is going to look pretty promising, and I would imagine that that would also coincide with a breakdown in the US dollar index. So it'd be worth watching both of those to see if they confirm a weaker dollar. Okay, this is a big 20-year chart of the US dollar versus the New Zealand dollar versus the US dollar. And we had a nice buying opportunity down here earlier in the year. just 2 or 3 months ago, where we touched that big trend line going back 18 years. If you remember, if you managed to get on that trade, you've done really, really well out of that. There was actually an inverse head and shoulders pattern, which I didn't make a song and dance out of because I was already focused on us bouncing off this trend line anyway, but I'll show you in a minute. Right, now we've become overbought on the weekly chart after this extremely good run. We're approaching the 100-week moving average. Now I need to scrunch this up again because I need to show you that the 100-week moving average is a significant enough line to pay attention to. As you see as I go back, right, well, I'll stop there. But you can see that the blue line acted nicely as support until it was broken. And again, nicely as support when we finally got back above it again. Again, nicely as support here and here. So it's worth paying attention to. Also nicely as resistance here and fairly decently as support there. Anyway, you get what I'm trying to say. The 100-week moving average, it's just worth paying attention to. And more recently, we reversed just below the 100-day moving average, 100-week moving average at the end of last year and the beginning of this year. So, and you can see here it had some effect. So, we were approaching the 100-week moving average, which is just below another fairly significant trend line going back to May of last year, which is a little bit higher. Where is that? 67.80. The 100-week moving average at 67. Call it 35. So this is the little band to watch where we might hit some resistance in this one on the longer term if you're looking for a swing trade. In the short term, we've got the 500-day moving average, which is not a surprise that it coincides fairly closely to the 100-week moving average, of course. So that's around 67.35, should we call it. We'd already broken above the 200-day moving average, and once we did that and then managed to bounce just above it, of course, we progressed forward. This is the inverse head and shoulders that I'm talking about, that I'd noticed, but I didn't bother to make too much of a song and dance about it. Because, as I say, we were already looking for the bounce at a lower level anyway off that trend line. But you can see it really has worked. Now, let me just check where the measured target for that is. Okay, if my maths is right, it's around 66.40, 66.50 is the measured target. So we've already hit the measured target, which means to me that it's no harm in looking for a potential turnaround. Now then, I seem to have some fibs going back all the way to this peak up here in 2017, and as you can see, we're just approaching the 38.2% fib at 67.20. So I'm going to suggest to you that we've got some resistance around 67.20, 67.40, and shorts would need a stop above 67.80. How about that? That looks like a reasonable trade, fairly low risk, and if we do reverse in overbought conditions, and if the dollar does start to turn around and push higher, the US dollar that is, against the New Zealand dollar, then this trade will work quite nicely, and I would imagine that we would be looking at potentially 100 and maybe 200 pip drop even for those swing traders who are prepared to run positions over the days, weeks and months ahead. Right, on that subject of the 100-week moving average being a good resistance level, we're looking at the dollar yen here, and that certainly has run into good resistance at the 100 and 200-week moving average in that sort of 109.60, 109.80 area. We've been selling that for a couple of weeks now, and every now and then that trade has worked. So I'm looking for this to turn around again. We bounce back towards it. I'm sitting on a short position. We're overbought on the weekly chart. We've also got that trend line going back over a year. So there's a lot of congestion going on, and we've even got a trend line going back to 2016, which is offering resistance. So this really has to be worth a short. You're probably short with me already. You've probably been sitting on that short for quite a significant period of time. As we've seen in this chart here on the daily chart, the 500-day moving average is now also a nice little ceiling to this market. 109.68 is where it's trading. Bollinger Band is just a little bit higher at 109.90. So we're overbought. Stochastics are just starting to turn down. I'm hoping the shorts start to work now. Break up through 110.00 will mean I'm wrong. It means that all the resistances have been broken out, and that would be quite a significant buy signal for obvious reasons. The euro yen is pushing higher. Yen obviously weaker against the euro. We broke up through the 200-day moving average. So we're building some sort of uptrend here. I should actually just quickly glance at the weekly chart, remind myself of what's going on. Okay, so we've got a recovery in a bear trend, and having broken through the trend line going back a year, that looks quite positive at this stage. We're testing the 50% fib at 122.61. I don't think that's going to be too much of an obstacle. It was a couple of weeks ago. Let's just have a look now and try and make some sense. The levels have been quite good to trade in this market, actually. Buying down here certainly worked, and that's an obvious reason why that would have worked. 200-day moving average coupled with that 23.6% fib down there propelled us through. So clearly we're going to have to get through up through 122.64. This is the only level that matters at the moment for this week. We reject that. We could go lower. Right, I've moved swiftly onto the euro versus the US dollar. I was a bit vague about the euro versus the Japanese yen, and this is why I'm trying to figure out what the hell's going to happen to the euro. I'm sure everyone is. It's been very much a sideways trend of late into the end of the year, October, November, December. Tricky to trade, I will have to admit, although the moving averages did their job. 100 and 200-day moving averages certainly did act as support and resistance levels, so they're always worth paying attention to. Now, trend line, not major trend line, goes back to August. We finally broke up through there, and then through the more important 200-day moving average and the 38.2% fib, which you see at 111.42. So that's a big candle, big blue candle on the 27th of December, busting through those levels without any hesitation whatsoever. So this all looks very positive, of course. The question is, are we in a sideways trend, and do we hold this trend line? Probably not, but it is the level to watch. 112.00. We get up through 112. Yeah, we get up through 112.00. That's the December high. Then that should be a nice buy signal. We will have already got up. We're testing the October high at 111.79. Is that the October high? This is 111.74. So yes, it is. So you can see what we need to do. We need to get through 112.00 for the buy signal. We have already held the 100-day moving average. We have already cleared the 200-day moving average. We've already cleared the 38.2 fib, 38.2% fib. So it all looks pretty good, and the stochastics are certainly looking positive. And then, of course, when we've looked at that dollar index chart, that means that we would have to be breaking down below, what was it now? Was it 97.60? I can't quite remember. In the dollar index. So there should be some correlating charts this week, which will give us some confirmation. And obviously, it would be really nice if we did start the year with some trends to just jump on, leave some positions, run some swing trades, make it nice and easy for us. Now, the US dollar versus the Canadian dollar has been hideous to trade for the last few months, because you can see no real trends for us to follow. No clear patterns whatsoever. However, we did break below this trend line. Let me try and get that up for you. We did break below this significant trend line going all the way back to 2017. We're through it, we're below it. We did break below it before and then recovered, but we've broken below that, and we've broken below the 500-day moving average, which is the green line here. Obviously, we're below the 200 and the 100. So this looks pretty negative. We managed a nice bounce to the trend line, which would have given us a selling opportunity, and then we've collapsed. Now, we're about to test, the next significant area on the daily chart, at least, is the October low at 130.36. Looking at the daily chart, there's nothing else particularly holding us up. But then you go to the weekly chart, and you see there's a 200-day moving average here at 130, well, the exact value is 130.73. We got down to 130.60 and bounced to 130.76, closed 3 pips above that 200-week moving average. So I would suggest that a break below, well, certainly Friday's low, or last week's low, I should say, at 130.60 would be a sell signal. It means we've really wiped out all forms of support, and then there should be significant risks to the downside. Certainly the weekly stochastics indicate that can happen. The daily chart, a bit of a mishmash, but it certainly doesn't contradict the idea that the market will go significantly lower if we break 130.60. Right, for weeks and months I've been calling this a bull flag in gold, and I'm happy to say that it was a great call. I was looking for a break higher eventually. I didn't know when it was going to come. I was, if you remember, looking to sell it around sort of 1480, 1492. There's